Hello, I'm Hans Lee from Livewire Markets and welcome to Views from the Top. Our guest today is Michael Della Vedova from T. Rowe Price. Michael is a portfolio manager for the Europe High Yield Bond Strategy and co-portfolio manager for the Global High Yield Bond and Global High Income Bond Strategies. Mike, welcome. Thanks for joining us.
Hi, welcome to be here. Thanks.
Let's start with high yield investing. I mean, I'm curious, what drew you to high yield investing in the context of your professional journey?
Sure. I look after our European and global high yield businesses and strategies. I'm originally from Sydney, but I've lived in London now for 27 years.
Where's the better city?
I like being home. I still call it home.
Good answer.
Still call it home. But one of the aspects, and why did I get into high yield? I used to do a lot of very credit intensive work when I was working here in banking in Sydney. And to be honest, I enjoyed it. Yeah. Maybe it's a bit nerdy. I liked it. I enjoyed it. I was told I was good at it. This was a big extension. Very deep into credit. That's what I enjoy doing.
You might as well do what you love, right?
Precisely.
So before we get into high yield specifically, I thought I'd ask you just for a general market view. Given all that we've experienced since COVID and really since 2008, how do you see the credit opportunity at the moment versus, say, equities or government bonds?
At the moment, because of all that uncertainty we've seen over the last couple of years, we've seen all sorts, COVID, war, increased inflation, central bank rate moves. It has caused a lot of uncertainty. But really, we're now at the point, especially if you look at growth, central bank moves, where we're going to. We're in an inflection period from macro type of risk, big picture risk, to credit risk. And I think that's where we are now. So really, being able to look at credit risk, that's on the up, and it's going to be that way for a few years.
Okay, all right. So let's now talk about your specialty area. We thought we'd use this particular interview, and given Mike's expertise, to make this really a masterclass in high yield. So why don't we just start with the very basics?
Sure.
What is high yield, and how is it different from other forms of credit?
Sure. High yield is an asset class within fixed income. So we get a maturity and we get paid a coupon. But it's corporate and it's sub-investment grade. So investment grades go all the way from AAA down to triple B, and we're looking at what's below triple B, single B, double B, and maybe triple C. It's riskier. They're corporate, it's a bit riskier, but it's still fixed income.
All right, okay. So what kinds of companies and sectors are issuing this kind of debt then?
All sorts.
Yeah.
All sorts. Some of the biggest sectors in the US, for example, is energy. Within Europe, it's banking and telecoms, heavily regulated. Within the EM world, the biggest sector is banking, heavily regulated. It's a great variety, all sorts of companies.
Okay, so we're talking about sectors there. I guess what kinds of companies are then issuing this kind of debt?
Do you know what? A lot of folks just think, high yield, no relevance to me.
Yep.
Let me tell you a story that has a happy ending.
Go on.
Okay. There's a couple, and they meet. I can't remember if it was Match.com or Tinder. High yield companies. When I did this, they're a high yield company.
Right.
They decided to go on a date. One wore some Under Armour, and someone else wore their Levi's. They both happen to have similar interests. They liked cars. They liked, for example, Jaguar, and they like Aston Martins. They liked high-end, nice performance cars. So they thought, what do we watch? They started to work out, well, let's watch TV. They both enjoyed watching Big Brother. And they found out they also supported the same European football team, Inter Milan. This was working out well. Let's go on a holiday together. They went to the United States and they flew United, which just happened to be powered by Rolls-Royce engines, and the tyres were made by Goodyear. Where'd they go? This was going very well. They went to Las Vegas, where they went to, you can pick any number of casino chains in Las Vegas, all high yield issuers. And they ended up getting married there. I told you it'd have a happy ending.
Brilliant. You can't get better than that for everybody. All right. So those are, I guess it just proves then, all being said and done, that it's really lots of different sectors, lots of different companies,
sectors.
All different kinds
you
of profiles.
You wouldn't realise. People are unaware this is impacting and they're around them every day.
Yeah, no, absolutely. So given all these companies you've mentioned then, I mean, some big heady names there, from Aston Martin to Match.com to United, why should an investor then look at high yield as a better opportunity than, say, simply just investing in the stocks that issue those bonds?
Right, two real big differences then. Yeah. One is it's fixed income. You get income. It's guaranteed. You get the coupon. It's contractually obligated. They have to pay. And we get a maturity. You know when you're getting your money back. That's the key differences people have to bear in mind.
Yep. No, absolutely. So I guess one thing that comes with high yield, people who even just read it fleetingly, there is this reputation that it is a riskier area of the credit market, right, due to the quality of the debt that's issued. You've already referred to that. But what indicators do you look at when you're investing to assess the quality of a company that is issuing this high yield debt?
Sure. You want to make sure, as I said, big things, you get paid that coupon. You want to make sure they pay you back. How much debt do they have compared to their earnings? What's their leverage like? What's their coverage? How easily can do those earnings cover that interest cost that they have? Do they generate cash? Basic things. Are they going to do better tomorrow than they are today? Are they improving? These are weak companies. You want to pick the winners and you really want to avoid the losers, and that's what you look out for.
Okay then, so in that sense, where are you finding the best risk-reward plays right now across the stack?
Right across the stack, it's almost a case-by-case basis. It's very different. We really focus on bottom-up, individual names, but we are finding good value right now in some of the better rated ones, double B, and some of the shorter dated. They're closer to maturity. That gives you the confidence that you're going to get paid back. That's where we're finding some good value.
Okay, good. So I guess you're talking about there about wanting to avoid the losers and how important it is to avoid the losers, because of course the losers are prone to defaults, right? There's this kryptonite for high yield investors. So are we seeing signs of increased default risk? What signs of increased default risk are we seeing given the current market conditions?
Look, the landscape's still relatively weak. Growth generally in the economy isn't there. We're still fighting inflation. Inflation's still tough, especially wage and labour inflation. Some of the signs are, look, defaults will likely go up. People always talk to me, they're going to go way up. They're not. The last time we saw that happen was the dot-com crisis and the GFC. It's not coming back to that. They will step up, but that you get compensated for that. That's what we feel at the moment.
Okay. And so that's defaults. And then the other big risk is, I guess, what professionals call the maturity wall.
Yeah.
So what is that and how do you manage that risk?
The maturity wall, well, what they're talking about is the amount of debt the market has to refinance in the near term. How big is it? Is it a wall? Look, if it is, it's not big enough to hurt Humpty Dumpty, put it that way. Think about it another way. Would you prefer to get paid back sooner or get paid back later? The market, after COVID crisis, preferred to get paid back sooner. That means you're going to get paid back. It's less risky, but that means you're going to get paid back in the next few years. A lot of people are saying that's a maturity wall. It's actually was the market taking less risk post-COVID and making sure they could get paid back sooner. It's not that much of a wall.
Yeah, no, absolutely. So putting this all together then, what regions, what sectors are looking the most and least attractive right now?
Right, as we discussed earlier, there's all sorts. But to pick one or two,
Yep.
we actually like European. You get paid in European names a bit sooner than you do in the US. The credit quality is better. When you look at and you take into account to make it all one currency, the amount, the coupon, the yield you're making, it's higher in Europe. And in sectors, we like names that you have to do a bit of work, you have to dig. The services sector, all sorts of different businesses there, and you can really work through and find these companies that are going to be winners. And the importance with some of the service businesses, and they could be anything from companies that arrange conferences, companies that do your outsourcing on IT, companies that provide all sorts of various services to industry. They may not be a lot of a cost to their client, but they're necessary. And so they are going to get paid, otherwise their client is going to have a big problem. It's that visibility on earnings that we really like within that sector.
You pointed to regulation. I thought I'd just follow up on that. So you're talking about heavily regulated banks in EM, also in Europe as well, utilities, so on. What role does regulation play then? If it's a more regulated industry, a more regulated company, do you want to be away from that or not necessarily?
It's case by case, but generally in some of the big areas, it's the rule book. You know what you're dealing with. You actually know the rules that are involved, and therefore you're able to work around that and find those opportunities. Without regulation, it can work in a commodity area, it can work, but you can see more volatility. Sometimes in regulated markets, you can see less volatility.
All right, okay. So one thing I didn't allude to, and one of the reasons we have Mike on today, is that Mike's been doing this for a long time, something around the order of what, 30 years, something like that?
Almost 30 years.
Almost 30 years.
Yep.
So, what is one thing you have become privy to that you wouldn't have realized or had access to if it were not for the position that you are in today and all the experience you had up until today? Indeed, do you have a view from the top?
My view from the top would be, and maybe I should have learned it sooner, but what I do has really helped. Really only worry about anything in life that you can affect the outcome of. If you can't affect the outcome of it, it's not worth worrying and stressing about. Focus on areas you can. And it's true at home and at work. That's my view from the top.
Mike Della Vedova, thank you for bringing the story, thank you for bringing all the lessons, and thank you for joining Livewire's Views from the Top.
You're more than welcome. Thank you.
And thank you for joining us. If you enjoyed that interview, why don't you subscribe to the Livewire and Market Index websites and our YouTube channel as well. And we thank you for watching.